Hello, I'm Professor Jacob Gold, and thank you for joining me today. Today I'm going to be sharing with you my second quarter market outlook for 2025. Right now we have a lot of dust in the air. There's a lot of uncertainty, and uncertainty brings volatility in the stock market. What I want you to focus on for this next quarter are three themes. One, lack of confidence. Two, perspective matters. And three, diversification is rewarded. Let's go into those a little bit more into depth. The first, lack of confidence. One thing we do recognize is that we are in an environment where tariffs are on the rise. If we actually see that the United States ends up having tariffs of 20 to 25% on countries like China and others, then we very well could see ourselves back in an environment where taxes were at this level back in the 1940s. So this is an environment where tariffs are increasing, and that puts a lot of pressure on pricing, and we are concerned that inflation might begin to tick up again due to the impact of tariffs. But there's just a lot of uncertainty. As quick as they come on, they can come off. Once again, this uncertainty is creating a lot of volatility in the short term. We also know that there's a lot of confusion and anxiety around government spending. 36% of our GDP is brought to us by government spending. And we do know that the US government is laying off a lot of individuals as well as looking to reduce the amount of spending. The question is in the short term, how does that affect the overall economy? Once again, a lot of uncertainty out there. We also recognize that in the month of February, we actually had one of the largest months of new job loss announcements. We can very easily see that in February of this year, the number of layoff announcements was very high. And that was a lot attributed to the number of government jobs that are being no longer fulfilled. Economic growth concerns. The ISM manufacturing survey suggests it's a leading indicator of an economic leading indicator, and it shows that new orders are declining a bit. Not to the point that we've seen recently or even right as we were entering into the pandemic, but nonetheless, we can begin to see that there is a downward trend there on new manufacturing orders. We also recognize, given all of this confusion and dust in the air, consumer sentiment is on a decline. And this is brought to us by the University of Michigan. And then, of course, we saw in early February the markets reaching all-time highs, and since then, the S&P 500 is now in correction territory. Corrections are fairly normal. Here in a few slides, I'll share with you how historically we have had pockets of high volatility, and in time, things end up stabilizing. But that's enough of the negative news. Let's put things in perspective. Things usually aren't as bad as they seem, but they also may not be as great as they seem. A lot of times they're somewhere in the middle. So the first thing is a high tariff environment isn't completely new or unusual. Back in 2018 and 2019, we had a lot of tariffs, and that did affect the economy, but overall, we still saw the economic environment improve. We saw that, yes, in 2018, the S&P 500 was down 4.38%, but then the following year in 2019, it was up 31.49%. So just because tariffs are on the rise doesn't necessarily mean that economically things are going to come tumbling down. We also recognize that right now there are still more open job positions available than there were pre-pandemic. Yes, we have seen that the demand has come down, but it is still substantially higher than it was in the past. We also recognize that, yes, there was some economic data from January that suggested that the economy was slowing, but some of that we recognize could be attributed to the fact that January was a very cold month, and when individuals experience cold weather, especially in the Midwest and in the East Coast, a lot of times that does affect their spending in that time period. So there could be some adjustments going forward that may not be as stark as in January. Another positive is that inflation is on that downward trend. We can see that inflation really peaked in the spring of 2022 and since then has started to come down. We're now at a reasonable level. Of course, with tariffs, we could see prices increase a bit, so we could see some new pressures when it comes to inflation, but overall, we've come a long ways in a short period of time. So there are some positive economic data out there. We just have to sift through it. And I think that that's really important for all of our clients to know, is that we're not managing our models based on sentiment. We are managing the models based on economic data. We are looking at GDP, looking at unemployment, looking at earnings per share, looking at sentiment. These are the things that drive our allocations, not what the media is saying or what the markets did yesterday or what we think they'll do tomorrow. And then the last thing that I want you to focus on in the second quarter of 2025 is that diversification matters. And we recognize that there are times when growth stocks might do extremely well and value stocks don't. And then there'll be other times like right now where people appreciate companies that are paying high dividends, that perhaps have good balance sheets, over a company that has high leverage and is looking to reinvest in their company to grow that company exponentially. So right now what we can see is that value companies that are paying high dividends, are weathering this storm a bit better than growth-oriented companies. We also recognize in diversification, and you all know this about myself, is that I'm a big advocate of people having both stocks and bonds in their portfolios. The stocks in your portfolio, it represents the offensive strategy. The bonds in your portfolio represent your defensive strategy. Together, they create stability and consistency. And this is important because we don't know what's going to do well in the markets tomorrow or in 2 months from now or 6 months from now. But if we have a little bit of everything in there and we have enough bonds in there to create a moat around our castle, then we can let things just work themselves through a bit longer than if we didn't have a strategy that was diversified. This is the last slide I want to share with you, and this is a daunting one. There's a lot of data points here, and I'll try to break this down and to show you some of the value in this. What this does is it goes back to 1980, and it shows how the markets have performed. Up above, this is where the markets ended the year. Below, it shows you the max drawdown of that given year. I think that's important because if we take a look at a year like 2009, we can recognize that in 2009, the S&P 500 ended up the year up 15.1%. But during the year, its low point was down 16%. So in any given year, we can have a really low point and we could still see the markets for the year end up being positive. And what you can see is there's a lot of downside. So the average max drawdown is about 14%. So we recognize that volatility is normal, but a lot of times we don't want to make a lot of moves when we're in the eye of the storm. But if we're diversified, if we have good perspective, then we can endure some of this volatility, and long term, we can have our money working for you. Because in my opinion, it's not so much trying to time the market as it is trying to find the right mix for you so you can have time in the markets. I hope you were able to take away a thing or two from this presentation. Know that my team and I are always here. If you have questions, concerns, we're just a phone call or email away. We are here for you. We'd be happy to talk you through your situation, answer your questions, and do some ongoing strategizing. So have a wonderful day. Thank you for taking the time to watch this video, and I hope you have a wonderful day.